Good afternoon, everybody, and happy 2024. Thank you for joining us for today's webinar from A&D Mortgage. Today, we're going to be doing an experts panel of incredible people who are going to give us insights into what we think will happen in 2024. We'll do a little bit of review of 2023, but joining us today are Max Slyusarchuk, our CEO and founder for A&D Mortgage. Our moderator today is going to be Rob Chrisman with the Chrisman commentary. And then we're also joined by Molly Boesel. She's a principal economist at CoreLogic. Alex Suslov, he is our A&D Mortgage's head of capital markets. And Jared Neale, he's an associate at the Imperial Fund, which is a sister company of A&D Mortgage that handles a lot of our securitizations on the capital markets. Let's go to the next slide. So just very quickly, we do have a Q&A button down at the bottom that if you've got questions, go ahead and type them in there, or you can also utilize the chat. I would ask people to turn off their cell phones if they could and not conduct business so that you guys can get the most out of the information that we're going to be discussing today. And if you run a little bit late, or you want to review any of this information, we'll be sending out a copy of the webinar recording within the next 24 hours after we're finished. So with that, let's move on to the next slide. Again, we just introduced our speakers, so go on to the next one real quickly. All right, okay, so for those of you who don't know about A&D Mortgage or haven't been working with us, we are one of the largest non-QM lenders in the country. We've been in business for approximately 20 years, predominantly in the wholesale space with a little bit of retail and correspondent. We're also a top conventional lender, an FHA, and then we are also the securitizer of our own loans with our sister company, Imperial Fund, which was founded almost 10 years ago now. Yeah, 10 years ago this year. Happy anniversary. And next slide. Skip this one too. Yeah, so for people who don't know where we're licensed, we are pretty much nationwide at this point. And we actually just about an hour ago received our license for the state of Oklahoma. And then in the past few weeks, we also got them for Iowa and Kansas. So we're looking to pretty much fill out the rest of the map by the end of the year. Currently, you do not need a business license. A license to do business loans with us in 40 states. But with that, that's the most about us. I'll return in a little bit, but I'm going to hand the mic over to Rob Chrisman. He is our moderator for today's panel. And with that, Mr. Chrisman, take it away.
Well, thank you, Carl. But before you actually log off, I did have a question about the states that you're licensed in. So you have a goal to go to be licensed and approved in all 50 states. Is that correct?
Correct. That is the goal, I believe. Mr. Slyusarchuk, he is our business owner. He will know better than I, but that seems to be the goal.
Okay.
Yes.
Take it away, Max.
That sums it up.
Yeah. So yeah, that's the goal, and I think we should just have a couple of states to go.
Well, congratulations on that. Yeah, having giving companies options like that, the ability to offer products and programs in different states is very important. So once again, Carl, thank you for having me and the panelists. And let's just jump in because there's a lot going on. There's always a lot going on in mortgage banking, and whether it's products or programs or rates or personnel, the economy and so forth and so on. I thought we'd start with kind of the big picture here, because everybody likes to talk about interest rates, and it's not so much that they rely on interest rate projections, but they are interested in hearing what experts have to say about interest rates and the direction of the economy. And I wanted to throw it out to the group who'd ever like to chime in. You know, we had Jerome Powell on December 15th. His comments about the economy, about the general direction of interest rates and possible tightening or loosening. What, though, specifically does that have to do in terms of this panel what does it have to do with the non-QM industry? What can non-QM specialists take away from Jerome Powell's comments from a couple weeks ago?
I can comment on that to start off the discussion for non-QM rates in comparison to conventional rates and treasury rates market. We definitely see that rates have climbed significantly during the past couple of years. Jerome Powell and the government was looking um, to calm down the economy a little bit and bring inflation down by elevating rates and reducing the economic activity. We see some results of it. And I can say that non-QM rates are actually more volatile than conventional in this case because of a shorter duration of a product. So when the direction of Federal Reserve changes into either way, you see a shorter part of Treasury slope to be affected more than the long end, than 10-year or 30-year. And when there is a change in the rates direction, non-QM feels it first. Moreover, with elevated rates, there were less product produced. Less product produced means there is much lesser supply on the market. And in that case, there's the equilibrium of supply and demand changes. So with the past year reduction in the production, that also affects the non-QM spread. So there's two components, right? Rate, the benchmark, and spread, which reflects basically risk and interest of the investors, basically the demand of the product, which Jared can chip in a little more on the demand side of the bond buyers. But overall, with the reduced supply of mortgage production, we are expecting to see a reduction in spread, thus a reduction in interest rates.
Mm-hmm. Yeah, absolutely, Alex. Just to follow up with you there, when we're looking at what Jerome and the Federal Open Market Committee actually said on December 15th, it was really great information and really great news for fixed income investors, right? We could see that pivot was clearly in the picture for them in that December 15th meeting, Rob, and it really showed in fixed income markets afterwards, right? December 16th and thereafter, we've seen a really significant rally in the treasury curve and in fixed income products in general. And it seems like that meeting was almost too positive for fixed income markets to an extent, so much so that we had some of the other Fed presidents come out afterwards, Williams and Bostic, that came out afterwards and kind of tried to cool down the market a little bit. I think the Fed maybe forgot that their job was to actually tighten the economy and cool things off. They got a little too excited. They thought their job was over, and so they kind of were declaring victory over inflation. But they might have gotten a little bit ahead of themselves there. So they tried to kind of walk back those comments shortly thereafter. But fixed income markets being what they are, they had already taken that news and ran with it, right? So we've seen really significant decreases in credit spreads across the board for non-QM RMBS, which is the asset class that Imperial Fund works with primarily, right? Taking the production from A&D and securitizing it, packaging it up into mortgage-backed securities for our big institutional investors. When we look at credit spreads, they've come down significantly across the board for non-QM RMBS. We've seen credit spreads down as much as 75 basis points from a high of 215, kind of 220 area, all the way down now to less than 150. So really significant changes there. And we're really looking forward to seeing how the market will develop into 2024. But like Alex said, right, non-QM, we're going to experience those changes first. And the change so far has been extremely positive.
Good. I wondered when in mid-December, when Fed came out with that pronouncement, and everybody got excited, as it were, the fixed income market, bond prices rallied, and which means rates dropped a little bit, or quite a bit, actually, significantly. And there's a lot of talk suddenly about, three or four rate changes in 2024. And of course, the Federal Reserve is going to come out and say, well, that's data dependent. Let's not get ahead of ourselves. But it seems like the market did. And over the last week or so, seems like the market rates have been creeping back up again, kind of a slinky almost effect. Do you think that that borrowers out there, and I'll throw this out to the group again, do you think that borrowers are starting to get excited? Are you hearing brokers say that, there's renewed interest in either refinancing or purchasing a home because of the interest rates move in the news? Once again, I'll throw that out to the group.
Yeah, I can address that, Rob, probably. We do hear a lot of comments from realtor community and from financial community that, hey, Fed's gonna do the cuts, let's all move forward, and we're all excited, and what are we gonna do? Rates gonna start falling substantially, and what's the plan? And it's, again, since we are still all very positive and really looking forward to lower rates, but like Rob, like you said, this board is very data dependent, and it's not that they will cut that in any case unconditionally. They do review the financial statistics on the monthly basis and then draw their decisions. So it's not 100% decided will there be cuts or not. We think that we might be in this high rate environment for quite some time, because the economic data, it's not dropping substantially to the ground. It's like tipping up. It's up and down, up and down. It's not nothing crazy going on.
Well, Max, I'm gonna keep the spotlight on you here. Where do you see mortgage originations in 2024 versus 2023? Just a thumbnail, just a rough throw a dart at the dartboard guess.
We have our analyst team is kind of doing this on the weekly basis, and the management looking on the predictions and analytics on the monthly basis. We do believe that originations will be higher, the applications will grow, but we don't think it's going to be craziness like a refinance boom or anything like that, because again, this Fed board is very data dependent. There is no indication that you have to cut the rates immediately. We believe that we still will be in high rate environment for a little bit here, and there is no way you can refinance from 7.5 to 7, for example. The drop should be more substantial in order to incentivize the broker to refinance the loan. So we do not see a huge boom in refinance. We do think that there should be more purchase market transactions, and there will be still growth for non-QM sector, because you still cannot qualify for conventional. Self-employed borrowers will have no choice but look for the alternative way for their transaction, and non-QM will continue to grow.
Yeah, I would add on the point about the refi. If you're a borrower who had a 7% interest rate, 5 years ago, and you hadn't refied yet, you're most likely not going to refi. So there's just, we look at our servicing data. There's about, 1.5 million borrowers with current interest rates above 6.5%, but only about 1 million of them purchased in the last, or got those loans in the last year. So those are the ones that are more, your refi target are those ones in the last year. So it's 1 million or less for those high ones. And you'd have, like Max said, you'd have to get interest rates down to about 5.5% to really see those want to refi. But there could be a little bit in there on the refi, but not a huge boom. So looking to be, you know, similar to last year, but a little bit up from that.
Right. Yeah, obviously the interest rates are one component of housing affordability. And when we're talking about the amount of business we're going to see in 2024, part of it is interest rates, part of it is supply coming on the market in terms of building, in terms of people selling their homes. And to narrow things down here a little bit, I wanted to ask Alex about affordability and you know, housing availability, because everywhere I go, people are talking about, oh, there's no inventory, or wages haven't kept up with you know, housing payments and so on and so forth. But I wanted to ask Alex, you have your finger on the pulse of you know, home prices. Where do you see, you know, looking into your crystal ball, where do you see home prices going in 2024?
Well, I can. That's a very good question, Rob. As far as housing availability, it is still has not fully recovered since COVID times. We see that there is a slight shortage of the new houses on the market, and construction teams, construction companies are working on building new properties, which kind of keeps the prices still high on the market. On the other hand, we see very significant drop in affordability. Today, the percentage of population in the United States who can afford a mortgage, who can afford a house, significantly dropped, and we see that in most cases, rent is more affordable than purchase and then a mortgage for the same size and same area house. That is why we see some areas, especially California, West Coast, where properties are very expensive to drop in value. On the other side, areas like Florida, Texas, where you see more businesses moving their operations to, where the government support of the economy is a little more significant and favorable. The property values are more stable there. There's definitely no crazy increase in property values in the past several months, and we expect that in 2024 the prices would stabilize and stay on the same level. But affordability is very tough these days, which can also affect prices to go a little down to make it more affordable for the U.S. nation.
Yeah, good answer. So when I was growing up, my parents had bought a house in 1967 in the Santa Clara Valley, Saratoga, very nice area. And I think they bought it for about $25,000. And over the years, I mean, they stayed there for the next 40 or 50 years. And I'd go visit them, and I'd get the flyer at the supermarket, and it would say, oh, this kind of house is worth this and worth that. And every year it would go up a little bit. And I would say, Mom, you know what? You look, you could sell your house for, you know, 100,000, 150,000. And she'd say, that's fine, Robert, but where are we going to live? We have to live somewhere. And housing price appreciation is part of the equation, but interest rates on mortgages, on existing mortgages, is also part of that equation, because borrowers, owners might be less hesitant to sell if they've got a 2 3/4, 30-year fixed mortgage. And I want to ask Molly, you know, we hear a lot about this lock-in effect for owners. And so, you know, have you come up with some kind of magic interest rate that rates have to move toward or hit before this lock-in effect dissipates and people start thinking about selling their home?
Yes, actually. Well, I have a guess, and let me tell you what I guess that it would be about 5.5%. Mortgage rates would need to get around down there. And to come up with that, just think about the median mortgage rate right now is about 3.5%. So all the outstanding mortgages out there, they have a 3.5% median rate. That's including, all lengths of terms and types of products. So if you go from a 3.5% rate to about a 5.5% rate, you would say you had a median price home, you'd increase your payment by $200-300. Not so bad, but where they were when they were up at 7.5%, you'd increase your rate by more like $600. So when we saw rates come down at the early 2023, we did see home sales really start to pick up. So if we could get a sustained drop in rates, and where people are more confident. We talked at the beginning here about the Jerome Powell comments in December. If we just have some confidence out there that rates are going to fall, even if someone does put their home on the market now, free up that supply, buy another home, they could buy a home at a maybe 6.5% mortgage rate and then refi it later. Just that confidence that rates are going to come down in the next year. But I think it's around 5.5. So we're not quite there yet, but we're headed in that direction.
Rob, we also have a statistics that we have calculated years ago, and we kind of constantly looking at these every quarter. And our statistics is about when people are okay to buy, meaning that if I'm a renter, what's the magic interest rate where I say, okay, at this interest rate, I'm okay to buy a house. And our numbers say it's 6.25. The minute it 6.25 or below, if I need to buy a house, I'll be buying. If I'm over 6.25, majority of people say, you know what, we will wait. So we saw and we analyzed like 30 years from here, 30 years back. And we saw the minute the interest rate around the 6.25, the demand is just substantially drops. So your 5.5 guess was when people gonna start selling, right?
Mm-hmm. Yeah,
it was
exactly.
a little different pivot. We were analyzing at what interest rate people are willing to buy, who wouldn't buy at 7.5%. What is this magic rate where I say, okay, I'm fine with this rate? I mean, lower is always the better. Just wanted to throw it out there.
Yeah, and that's a good point about rentals, because rents are going up at high rates as well. So, buying and locking in that mortgage payment every month makes a lot of sense.
Yeah, I would, Molly, I would echo that sentiment to a great degree. When I talk to originators, whether they're brokers or loan officers working in a bank or an IMB, they keep coming back to what is the payment? What is the payment? What is the payment? Not regardless of interest rate. Obviously, interest rate figures into that, but also the price of the home and how can we figure out. And that's one of the big things that I always tell groups is, look, you are dealing with people, and your ability to explain payment and figure out ways that you can help them almost despite interest rates. Obviously, interest rates figure into that, but how can we make this work? You want this home in this neighborhood, and yeah, whether interest rates are 5.5% or 6.5 or 7.5, let's figure out how we can make that work. And that's a huge advantage that brokers and originators have over some internet lender, for example, the ability to work with their borrowers to figure it out. Of course, we've been focused on kind of the front end, the primary market, dealing with borrowers and affordability and interest rates and so forth. But let's switch gears here somewhat and talk about the product of the manufacturing process, the security, the end product, as it were, once the loan is funded. And I wanted to ask Jared, securitization is obviously a key factor in all of this, because if you're making a product, whether it's cars or mortgages, you need a buyer. You need an outlet for that product. And I wanted to kind of dive into the weeds here a little bit with Jared and find out if you could share with the group, with the audience, what is the securitization market like? How does that work? What are the things that you are looking at?
Absolutely, Rob. Happy to. The securitization market is critical for the U.S. mortgage market in general. Non-QM specifically benefits greatly from the securitized products market, but the mortgage market in the U.S. as a whole is completely reliant on securitized products. And my favorite example to cite for that is going to be the 30-year fixed mortgage. Right? It's something that's synonymous with mortgage lending in the United States, something all of us are extremely familiar with as the most popular and primary product that borrowers are looking for when they're going to try and get some mortgage financing. But you'll also find that it's a uniquely American product. You do not see 30-year fixed mortgages anywhere else really in the world, in the amount of in the volume that you do in the United States. And really, it's just a product of securitized markets. The only reason really why US lenders are able to provide that 30-year fixed product to borrowers is because they have that takeout, that securitized product exit that other originators in other countries do not have. So the way that we all view the mortgage market in the US today has been completely influenced by securitized products. And effectively, what do I do and what do other folks that participate in that market do? We provide liquidity to lenders. Right. So when lenders like A&D Mortgage and others build up a significant portfolio, they're really doing a great job for their brokers. They're providing a great service for their borrowers, and they're growing and they're lending a lot of money. What folks like Imperial Fund will do is they'll step in. They'll say, you've done a great job originating this portfolio of mortgages. We'll go ahead. We'll purchase that portfolio from you. We'll give you the cash now so that you can continue your business operations, right? You can continue lending out money to borrowers that are seeking mortgage financing. And we will take the risk, right, the loans off of your portfolio. And then what we'll do is we'll syndicate that risk out to many different investors, institutional investors across the board, right? So we're going to the BlackRocks of the world, the Blackstones, these very large asset managers, and we're selling them little pieces of risk from A&D Mortgage's portfolio and the portfolios of other mortgage lenders. And in return for that risk, right, they're getting a yield determined by the interest rate on the underlying pool of mortgages. So it really works well for everybody, right? The lenders are getting access to liquidity so they can provide that lending service to more borrowers. The borrowers are getting more access to mortgage financing because the lenders are more liquid. So they're able to provide better products like a 30-year fixed mortgage, where borrowers in European countries, in Australia, in the UK, and France, and other places where the predominant product is an adjustable rate mortgage, right, an ARM mortgage. When you have rates increase dramatically like they have recently, the payments that those borrowers are now making are significantly greater than what they were when they took those mortgages out, right? With a 30-year fixed mortgage, the borrower doesn't have to worry about payment shock, about something changing on them and having to come up with additional capital to be able to pay their mortgage. In Europe, though, borrowers are really feeling it. It went from a 3% burden to some of these borrowers where their mortgage payments are really not a significant burden for them, all the way up to 7%, where a significant portion of their savings is now going towards making these mortgage payments. So it really is of great concern to other countries to be able to fix their mortgage payments at a specific rate, and securitized products allow borrowers to be able to fix their mortgage payments for 30 years and not have to worry about interest rates going up or down, and all the wonderful stuff that comes with adjustable rate mortgages. Securitized products provide that liquidity to borrowers, to lenders, and to the U.S. market as a whole.
Very good. Well, obviously, if I'm a money manager and I can earn 20% on something that that has the same risk profile as a 10% security, I will want to earn 20%. If I can earn 8%, the same risk as 5%, I want to earn 8%. But I wanted to ask Max, part of the reason why mortgage-backed securities, whether they are, agency mortgage-backed securities or non-QM securities, are higher than treasury rates. Obviously, there's a credit risk and there's a prepayment risk. And the non-QM spreads, we talked about non-QM spreads earlier in the discussion. What do you see happening with the spread in the non-QM securitization market?
Rob, that's a question to me, right?
Yeah, Max.
Yeah, here's what happens. Once the interest rates going up and everyone expects the rates be a little higher, then spread widens. So the rates for non-QM and other proprietary products, private label security is going a little up. The minute there is a message from Fed, and it's been pretty strong message that we are done and we are thinking to lower this, but at least no economists on the Wall Street think that they will be, hiking the rates anymore. So it's either they will be steady or they will start drops when the economic data will allow that. So at this moment, the spreads are going to shrink. So like Alex said earlier, the spreads have tightened already, or Jared said, I'm sorry, the spreads have tightened from 120 to less than 150 already, and we believe that it will be continuing to tighten again. The minute you see the first cut from Federal Reserve, the spreads will tighten even more. The spread's going to be like 150 up until this first cut. The minute the first cut is going to be there, the spreads will be 100 or less. So that's what I personally think how spreads are going to play.
Interesting. All right. So I want to return to Jared. Credit spreads. Can you tell the group about how credit spreads impact loan pricing?
Absolutely, Robin. And this one will sort of be a tag team between Alex and I, capital markets at the mortgage company, and then capital markets for an aggregator like Imperial. Credit spreads, right? What all the credit spread is it's a premium that bond buyers, right, are looking for their risk, right? So whatever the risk-free rate is, the credit spread is the difference between the risk-free rate of a treasury bond, right? And then the rate that the bond buyers are looking to receive for taking the risk on a given portfolio. So credit spreads effectively are the pricing that I get when I go to sell my mortgage-backed securities to the large asset managers, right? And the pricing that I get is going to determine the pricing that I can give to mortgage lenders like A&D and other participants in the space. So there is a direct correlation between credit spreads in the secondary markets, right, in securitized products markets, and the pricing that borrowers will see and brokers will see for loans on when you're going for mortgage financing. Alex, I don't know if you want to add a little bit more on that, if you've seen an exact correlation between the two, but basically from what I've seen, when we see credit spreads decreasing, we see pricing get more competitive for loans when borrowers are going to get that financing. Alex, is that consistent with what you've seen on your end as well?
Yeah, that's right on point. It works obviously a little bit like a steering wheel on the boat, not exact same minute change, because usually when there is something changing on the market, there is several parties from investor to securitizer, issuer to mortgage company, and then to final borrower. It takes a little time to react to the market condition. But overall,
So Alex,
obviously,
oh, I'm sorry.
Yeah.
But who
Yeah.
is it purely the market that determines credit spreads, or is there some overlying, force?
so there is several components that determines credit spread for the borrower, right? First of all, the demand, which reflects the non-QM spread that Max and Jared were talking about, and then for each particular borrower, based on their credit characteristics, their income, their debt-to-income ratios, their debt burden, the collateral itself, the property. There are different risk characteristics that affect the probability of the borrower to default, what probability is there, and then also loss severity, of which basically means if the borrower default, with which likelihood investor will be able to recoup the funds invested in that particular mortgage. So those two components add up to credit spread for the borrower. So credit spread for the borrower plus non-QM spread that incorporates the full spread that the borrower basically gets for their credit characteristics.
So I would imagine that a fair chunk of an investor's day is spent analyzing borrower characteristics, loan characteristics, pool characteristics, trying to see value there that their competitor investor may not see. Is that Jared, does that sound about right?
That's exactly what we're looking for, Rob. We're looking to identify characteristics in an underlying pool of mortgages that put it above, from a credit perspective or from a yield perspective, put it above and beyond what we're seeing in other places. That's absolutely the case, Rob.
Yeah, and those characteristics, just like Fannie Mae and Freddie Mac, agency product, those risk characteristics, find their way into the primary market in terms of rate sheet and loan level price adjustments, and a hit for condos, for example, because the risk historically on condominiums may be judged as being higher, calculated as higher. So there's going to be a loan level price adjustment for that. Speaking of non-QM versus QM, agency, non-agency, and so forth, I wanted to dive in to the product set, and I wanted to ask Alex specifically, what the non-QM market has been around for over 10 years now. Products come, products go, their developments, and so forth. What are the most recent trends in terms of the non-QM marketplace for products?
That's a very good question. I would say non-QM niche focuses basically on borrowers that cannot qualify for a regular conventional mortgage. Usually it is due to income characteristics. Most of non-QM borrowers are self-employed. So for self-employed borrowers, we offer alternative income verification options like bank statements, P&L loans, profit and loss statements, asset utilization programs where borrowers may provide their assets, their liquid assets, to be qualified for mortgage. So that is one of the niches non-QM covers. And the second one is investor loans, which incorporates investor DSCR loans based on property cash flow and rental income that the borrower can generate on their property. So those are the main two niches that non-QM covers. As far as new developments in non-QM market, we see elevated demand on short-term rentals. We also see more demand for condos, since you cannot finance condos on conventional or FHA loans. That is more of an investor loan for non-QM niche. Those two most recent developments. Also, we see foreign nationals being financed on non-QM loans and non-permanent residents, including those who might have some immigration uncertainties in between of being a foreign national and a non-permanent residents. Those categories called ITIN borrowers who have ITIN numbers, but they live and work in the US. They pay taxes in the US, and basically they're permanently living in the States and can provide a decent income history.
Yeah, ability to repay is obviously important. I want to ask Molly, what types of loans do you see, Molly, having the best, potential for success in this? Here we are in 2024 already. in 2024.
Yeah, I mean, it goes back to what I think Max was talking about, affordability, or everybody's been talking about affordability today. It's just going to be the boring old 30-year fixed, right? You'd think that the ARM products would be getting more popular. They were when rates were, higher last year, but the popularity of them has come down a little bit. So pretty much the 30-year fix. Some borrowers who more savvy might be demanding the ARMs, like some short-term ARMs if they know rates are going to come down. But that is a pretty big risk you'd have to take there on the ARM. So really just the 30-year fix. And then we haven't talked about home equity. Home equity accumulation is at an all-time high. And with home prices being high, again, lock-in effect, all that great stuff. A lot of people are staying put, wanting to renovate their homes. They'll want to take out a home equity loan to do that. You could also take out a home equity loan and write off on your taxes if you buy a second home with it or an investment property. So as long as you're using it for a property, that home equity loan is the interest is tax deductible. So those are the different types of products. But the remodeling is going to continue. It's not going to be as big as it was in the last few years, but it'll continue to be pretty strong.
What about Molly? Continuing on that vein, this is a little off topic, but I wanted to ask you while we've got you, the reverse mortgage business. Is that a big thing out there from your perspective?
Well, I don't follow too much the reverse mortgage, but it's you'd think it should be, but it hasn't had a big pickup yet. So yeah, we would be looking for reverse mortgages to pick up a bit, especially with the aging population.
Yeah. 10,000 people a day turning 62 can't be ignored. I wanted to ask Max though, and Max, you alluded to this earlier in terms of refis, and obviously people on the call here know that refis can either be rate and term or cash out, and rate and term might be kind of lukewarm until rates go lower, assuming they go lower. But obviously there are millions of borrowers out there with credit card debt, and I think credit card debt hit $1 trillion late last year. A lot of that credit card debt is 25-30%, which is not tax deductible. And so that kind of cash out refi may pick up a little bit. What are your predictions though for this year in terms of refis in general, a mini boom or a major push or somewhere in between?
We wouldn't necessarily think that there will be even a mini boom. There will be slightly more cash outs, because as you say, Rob, if if the borrower has a lot of debt on the credit card, I can, if the rate drop, I'm more willing to go and take that and make it tax deductible and refi that. But cash outs are very small portion of the production today. And will they raise a little bit? Probably, but not substantially to call it even a mini boom. It will be slight increase in cash outs, slight increase in purchases, and no true refinances. So if say there will be status quo, that Fed will not raise the rates, they will be promising to do that, and the rates will slightly be dropping looking forward to those cuts, we will see a slight uptick. We do not believe there will be even mini boom. Don't get me wrong, we're super optimistic about the mortgage business overall after the Fed's message, and the fact that they stopped hiking the rate brings all the hopes to the market, and we hope we're gonna stop losing the mortgage lenders from our map, and maybe even gain some newcomers, because wholesale business completely died in the last 2 years, and borrowers don't have any choices today. Once it comes to conforming loan, there's UWM and Rocket, there is nobody else out there even competing, and all the brokers would like to have a choice, and to see more people doing that. So we're really very hopeful that the market will be growing and new people will come on board.
Yeah. The coastal areas obviously are a big part of mortgage production. I want to ask Jared or Alex, what do you guys see in terms of jumbo production for 2024? Especially, it'd be interesting for brokers who specialize in jumbo production to hear your thoughts.
Jumbo market was significantly down, to be honest, in the past year due to reduced securitized production, because banks were mainly fighting for that product in order to have a cross sell for their customers, and they were giving a better rate to get deposits from customer, and they were kind of compensating those low rates by the deposit income. That's why securitization market for jumbos was significantly down.
Yeah, so to talk a little bit about the securitization market for jumbos, Rob, in 2022, gross issuance for jumbo RMBS 2.0 was about 19 billion, excuse me. In 2023, that number was roughly half to 10 billion. So
wow.
we've seen a really significant decrease in gross issuance of jumbo 2.0 RMBS year over year. And expected for 2024 is another pretty light year, but analysts are keeping their cards close to their chest as far as expectations for 2024, because things could go in many different directions depending on the rate environment and the economy, right? As Jerome Powell said, all eyes are on job reports at this point in time, and unemployment and other factors like that to see where the FOMC takes the economy this year.
Yeah, and then to go from 10 billion to 15 billion, someone will say, oh, jumbo production up 50%. Somebody else will say, oh, jumbo production was only up 5 billion. So different ways of looking at the same statistic. One of the things that I hear about in my daily email bucket is AI and technology and so forth. So we're switching gears here again a little bit, transitioning over to something that brokers, I'm sure, hear a lot about. And I wanted to ask Max, what are some of the things that A&D will be doing this year, to the extent that you can share them. We don't want to ask any trade secrets, but what's A&D up to that you can share for this year to help brokers?
Well, we've came with the whole suite that we want to give to our partners. We have our completely new broker portal, which has a lot of AI capability with OCR, doc recognition, characters recognition, and it's gonna tell the brokers what's they missing, what they have to upload, and there's a lot of interesting infrastructure we've done. This is on the testing. We have a small group of brokers that are testing our new portal with AI capability. We are planning on March 1st to release it broadly to all our partners. Also, at the same time, we're gonna release like a Power Corner. This is the CRM that we give to our partner free for use. This is like a marketing tool, which includes CRM, marketing material, email campaigns for their borrowers, and a lot of tools that they can use. We're trying to create and give as much as possible to our partners to support them during this crazy economic times and high interest rate environment. One more thing that we came out already on the testing is our Advantage program. That's a loyalty program where you get points for every loan you close and for every webinar you participate with us. So that's pretty big one as well. You can use the points to buy down the rate, extend the lock, remove underwriting fee, et cetera. Very, very interesting product where we have a lot of referred brokers who close a lot of loans with us, and we're going to start rewarding loan officers for doing that, so they can have a competitive advantage that they can provide to their borrowers.
Interesting. Well, congratulations on all of that. It certainly sounds like a good thing for brokers. Taking a step back to artificial intelligence and AI, everyone seems to want to talk about AI. Maybe AI will have more oomph for mortgage bankers than, say, blockchain did. Blockchain, everybody was talking about it for a while, then it kind of died off and nobody really bothered too much about it. It may come back, of course, but AI seems to have a different footing. And I wanted to ask anybody who'd like to chip in or contribute here, any thoughts on artificial intelligence, especially in terms of how it might help the broker industry?
I can give our A&D perspective, what we think that is with ChatGPT, with Google coming out with their AI. The essential issue is the company has to have a development team to implement it. It's not that, hey, you can just connect to ChatGPT, there's a link connecting, and all of a sudden underwriters don't have to underwrite anymore, and ChatGPT underwrites for them. Unfortunately, doesn't work like that. It's these artificial intelligent brains, you can plug them into very narrow pieces of your production, but the company has to have its own development team to do that. It's not done by itself. We A&D we operate all our softwares, right? We have proprietary servicing software, we have proprietary OCR, categorizer, doc system, pricer, LOS, it's all our technology, and we have implemented already all the artificial intelligence inside, but unfortunately, not everyone can do that. There are huge lenders who still use third-party solutions, and there is no AI that they're implementing, and they at mercy of this company to do that. And then there is no difference if you're using a big solution like, I know, LMA or, whatever the solution you use, that it's used by everyone, there is no competitive advantage. If these guys are gonna plug something in, that would be for everyone. So what did you gain? You gain zero, because they plugged it in and now everyone is using it. So there is no competitive advantage for you, because what we are looking to do is to build something that no one has and revolutionize different things. And unfortunately or fortunately, you have to have your whole big development team. You need engineers, front developers, back developers, database administrators, testers, UX, UI designers. You need hundreds of people to put this to work, to make it work. Otherwise, unfortunately, you just limited to go in on Google and ask, hey, Chat GPT, describe me buildings on the moon, and they will just give you, some, interesting ideas. But in order to implement this and you need OCR to scan this, you need AI to recognize that, you need BPM software to put the rules in, and then use the Chat GPT or Google, and then transform this. You need a lot of development. It's not that easy, but we have a lot of things that we already have done, and we're releasing the new broker portal with all these capabilities on March 1st. It's in the testing with a small group right now.
Very cool. Well, we're almost out of time. I have one question left, and I'll throw it out to the group. Obviously, the things that we've talked about, Max, the things that you were just talking about, have to deal with brokers helping their borrower being the ultimate consumer and the ultimate measure of something, whether it's effective or not. And I've heard word that in my discussion with brokers, there are still borrowers sitting out there who may have misconceptions, preventing them from say buying a home, from getting a mortgage. Is there anything the group would like to say that can help brokers on the call here dispel those misconceptions, like a sales pitch or some kind of technology or interest rates? What's going to help a broker, like I say, dispel those borrower misconceptions about getting a mortgage?
Well, we think that the best idea for the broker is to give a voucher to the borrower that the minute the interest rates drop, I'll pay for your appraisal once I'll be refinancing your loan. That seems to work the best, because interest rate is the stopper of buying a property. It's super higher rate environment, and the only way to convince the borrower to do that is to say, look, here's what feds are saying. I'll refinance you in a year or two at 4%, and your appraisal is on me.
Very good. Anyone else?
I like that one, because when you refi, you pay the appraisal, all the extra fees, and if it's a fresh loan, do you really need all that? Not necessarily. The house probably hasn't changed very much. And then working with the borrowers on their down payments. Do you really need 20% down? If you want to put the 20% down, can you get the funds from somewhere? Working on the down payment, working on the monthly payment.
So the minute the interest rate will start falling, the prices may go up, right? The falling of interest rate will trigger the prices going up. Buying now, you can fix your price today, and you will refinance and get the better rate later on, but you already got the price and you have it fixed, and I will pay for your appraisal once refinance.
There you go.
That's a pretty good conversation, and that's the only one that we believe are real, truthful, and it works.
There we go. Well, we've run over a little bit here, but I wanted to thank all the panelists for your contribution. It's been very educational, I hope, for the brokers on the call here. Carl, any closing notes before we
Ye-
end the call?
Yeah, just a couple of quick ones. Well, there's some questions that popped up that we'll answer after the fact, but I wanted to remind people of a few quick things, and it'll help wrap up some of what we've discussed. Next question or next slide. First thing I would say is scan this QR code if you can. That will take you to a link tree that'll access all of our social media. So you can get updates on all the tech platform releases that Max has indicated, a couple product releases or any new states that we expand into. And again, everything is about us being your partner for growth. I think we typically hit these 4 major points in pretty much every webinar that we do, but the strength of becoming our partner is really to these 4 pillars, which is we've developed a very streamlined loan process. We are all 100% committed and focused on getting you to the closing as fast as possible with the least amount of hassle for you and your borrowers. So that comes through in the knowledge base that we have with our account executives, the attitude that you'll see from everyone who works here on your loans. As Max and Jared have talked about, with Imperial Fund, we have the ability to do our own underwriting on the non-QM products, so that allows us a greater deal of flexibility in terms of who we lend to. But at the same time, also we're keeping our finger on the pulse of what's going on, so that we are able to develop loan portfolios and loan solutions that'll help the brokers grow their business. Part of what we talked about with this idea of the misconceptions that are going on and some of the other aspects, I would encourage you guys to check out our blog a couple times a week. We're always posting new content, whether again it's about new products, but we also do quite a lot of broker education pieces, usually multi-part pieces that also tie to a monthly webinar on a particular topic. The last couple months we focused on doing things related to artificial intelligence. And then every month we also do a deep dive on a specific loan product. So within the next 2 weeks, we're going to be doing one with Mark Glazer on the DSCR loan. I think everybody indicated that's still got a pretty good lifespan, they think, in the 2024 market. So we'll be happy to be discussing that with Mark. And then every month and next week, we'll be kicking it off. We do a broker orientation, and we do that for our new brokers to help them get familiar again with the products that we offer, our loan process, our tech tools, educational opportunities, and then we'll expand it to talk about things like the loyalty program. It's also a good refresher if you're an existing broker, just in case there's something you haven't been aware of in the last couple of months that has changed, and we can cover that. And then next month, we'll also do a deeper dive on the bank statements programs. So that'll cover a big chunk of what we got going on. And again, so this QR code, if you're new to hearing about us, we would encourage you to go here, fill out a broker package, become approved. I think Max would assure you that once you try us, I don't think you're going to want to go anywhere else. I mean, we've grown substantially over the last couple of years for a reason, and it's a lot to do with everything that Max has trained everybody here to do in terms of customer service, the products that we offer, and everything else. So I would highly encourage everybody, if you're not partnering with us, now is a good time to do it. So with that, we're going to close out. I'd like to thank all of our panelists, Max, Jared, Rob, Molly, Alex. So thank you guys for all the great insights. Again, we'll be sending out a recording of the video probably within about the next 24 hours, along with a couple other things. And then there'll be a brief survey. So if you, as you're logging out, you could give us your feedback, we'd greatly appreciate it. With that, I'd like to thank everybody for a wonderful day. Have a great rest of the month. And we will be signing off.
Glad to be here with you guys.
Thank you. Thanks
Thank
for
you,
hosting.
everyone.
Thank you very much.
Bye, guys.
Right. Thank you all.